All right, let's jump right into this explainer. Today, we're investigating a massive, frankly wild disconnect between what the financial industry markets to us and what the actual hard data proves. We're looking at a phenomenon that literally costs everyday investors billions of dollars every single year. But don't worry, it's not all doom and gloom. More importantly, we're going to outline a beautifully simple alternative that actually puts the mathematical odds back where they belong, in your favor. You know the drill. You've probably seen those glossy, heavy stock marketing brochures claiming absolutely incredible returns. Maybe your bank or financial advisor even handed you a beautifully designed little packet showing exactly how their hand-picked, actively managed mutual funds consistently beat the market. And hey, it sounds great, right? I mean, why settle for average when you can pay an expert to deliver exceptional results? Well, today, we're going to look past that slick marketing and dive into the hard evidence to see if those claims actually hold any water. Financial writer Robin Powell has this brilliant analogy. He says, think about handing your school report card to your parents. You don't hand them the whole thing, obviously. You just show them the good pages. And what's wild is that the fund management industry has been using this exact edited school report tactic for over 2 decades. When a fund family presents their track record, they aren't giving you the whole picture. They're just handing you the pages where they got an A in art or PE, while quietly leaving the failing grades buried at the absolute bottom of their backpack. Which brings us to Section 1, the harsh statistical reality. So let's pull back the curtain and look at the full unedited report card. This comes courtesy of the S&P Dow Jones indices. We're not just looking at the funds that managed to survive, we're looking at the entire classroom of active managers to see how they really perform over time. Enter the SPIVA scorecard. This is basically the de facto independent scorekeeper of the financial world. And it's crucial because it corrects for something called survivorship bias. See, when a fund performs terribly, the management company doesn't usually advertise it. They'll often just merge it with another fund or quietly close it down to literally erase the bad track record. But SPIVA doesn't let them hide. It tracks every single fund available at the starting point, giving us the absolute unvarnished truth about active management. And man, that truth is a serious wake-up call. In 2025, a staggering 79% of all actively managed large-cap U.S. equity funds completely failed to beat the S&P 500. Just let that sink in for a second. Nearly 8 out of 10 highly paid Ivy League-educated fund managers couldn't even beat a simple, unmanaged index. It's kind of hard to believe. In fact, 2025 was actually the 4th worst year for active large-cap managers in the entire 25-year history of the SPIVA scorecards. But it gets worse, because this brilliantly illustrates the long-term truth. Outperformance is incredibly, vanishingly rare the longer you stay invested. Over a 20-year horizon, an absolutely astonishing 93% of active large-cap funds underperform the market. Think about what that really means. If you're investing for a long-term goal like retirement, relying on an active manager gives you just a tiny 7% chance of actually winning. You are essentially paying a premium fee for the near certainty of losing to a basic index fund. So the really crucial point here is that outperformance isn't even about skill. Like, what if a fund does actually win 1 year? Can it keep winning? Well, the persistent scorecard reveals that out of all above median large cap funds, only 4.5% remained persistently in the top half over a 5-year period. Now, to put that into perspective, if you just flipped a coin, pure random chance, you would expect a 6.25% persistence rate. That literally means highly paid financial professionals actually perform worse than a literal coin flip. The persistence of winning managers is actually lower than what you'd expect from just pure random luck. In fact, there was this one study analyzing over 2,000 U.S. mutual funds, and it showed that for the tiny fraction of managers who do appear to generate positive alpha, actual outperformance, you would need 153 years of data to statistically prove it was due to genuine skill rather than just getting lucky. 153 years! Nobody has an investing timeline of a century and a half. So, unless they've somehow discovered the fountain of youth, statistically proving their skill is just not happening. Moving on to Section 2, a worldwide epidemic. Let's take this to the global stage, because this underperformance, it is definitely not just an American issue. It's a full-blown worldwide phenomenon. The myth of the star stock picker is basically failing investors everywhere. Whether we're looking at Latin America or New Zealand, the data proves that across all asset classes and styles, active management outperformance is completely fleeting. Just look at the numbers. In Brazil, only 1 out of 81 top-performing equity funds maintained its status for 4 years. Just 1. In Chile, exactly 0 top quartile funds persisted that long. And in New Zealand, 85% of active equity funds underperformed over 15 years. The narrative is absolutely identical across the globe.
Which leads us to Section 3, the magician's secrets.
So you might be wondering, how on earth do active fund families continually claim that 90+% of their funds beat the benchmark if the global data universally says otherwise? If the math is so clearly against them, how are they legally publishing those glossy brochures? Well, it's pretty simple. They hide the bad grades using 4 primary marketing tricks. First, they cherry-pick their inception dates. They'll start the clock right after a market crash to artificially inflate their long-term returns. Second, they compare themselves to inappropriate, super easily beatable benchmarks. Third, they highlight short, maybe 3-year windows where luck just happens to shine the brightest. And finally, they report returns gross of fees, completely ignoring the massive costs that are actually eating into your wealth. To see this exact trick in action, let's look at Capital Group. Recently, this major active management firm proudly claimed that 91% of their equity funds outperformed. Sounds amazing, but once you actually deduct the fees that investors were forced to pay, that number instantly dropped to 84%. And let's be real, a 7 percentage point gap is not a rounding error. That is real, hard-earned money leaving your retirement account and going straight into the fund manager's pocket. All right, Section 4, the honest path, the 3-fund portfolio. Okay, enough about the problem. Let's shift gears to a really warm, simple, and frankly, grandfatherly solution to rescue your retirement from all these deceptive fees. You do not need to play their game. There's a deeply honest, highly effective way to build wealth. Enter the 3-fund portfolio. Championed by 94-year-old World War II veteran Taylor Larimore in his Bogleheads Guide, this approach uses just 3 broadly diversified, ultra-low-cost index funds: a total U.S. stock market fund, a total international stock fund, and a total bond market fund. It's brilliant because it entirely eliminates manager risk, stock picking risk, and those sky-high fees. It's the ultimate set-it-and-forget-it strategy. And figuring out your asset allocation with this is so incredibly easy. Taylor's golden rule is straightforward. Literally just hold your age in bonds. The logic here is that as you age, your ability to recover from a sudden market crash decreases, right? So your portfolio should naturally become a bit more conservative over time. It's a remarkably reassuring, common-sense way to approach risk. Let's look at how this actually applies in practice. Say you're a 30-year-old investor. This elegantly builds a super straightforward recipe for you. You start with 30% in bonds, matching your age. Then you take that remaining 70% of equities and just split it between domestic and international stocks. So maybe 56% total U.S. stock and 14% total international. By doing this, you're capturing the growth of the entire global economy, and you never have to guess which specific stock or which hotshot manager is going to win. Then, as you age into your 60s, your portfolio gracefully shifts to, you guess it, 60% bonds. You're automatically reducing your risk, essentially locking in and securing all that wealth you've built over the decades. And the best part? You're doing the whole shebang without paying a single expensive advisor to do it for you. You are in complete control, paying mere pennies in fees compared to the billions that get lost to active management every year. Which brings us to our final section, Section 5, staying the course. Now, we've got to be honest here. Having a right portfolio structure is really only half the battle. The other half? That is entirely about investor behavior. You could have a mathematically perfect portfolio, and it will still completely fail if you panic at the wrong moment. As Taylor so wisely points out in his book, when a bear market hits, the financial news is going to scream that the sky is falling. You are going to be strongly tempted to sell. But listen, the ultimate rebellion against a complex, fear-mongering financial industry is having the iron discipline to simply do nothing. Seriously, do not sell during a panic. And this right here is the absolute core of the Boglehead philosophy. Invest early and invest often. Diversify as broadly as humanly possible. Use low-cost index funds to capture your fair share of market returns. Keep your costs and your taxes at absolute rock bottom, and above all else, stay the course. If you can just ignore the daily stressful noise of the markets, you put the mathematical odds of success firmly back in your own corner. So, I want to leave you with this final provocative thought. Go log in and check your portfolio today. Really look at the funds you own and the actual fees you're paying. Ask yourself, who is really profiting from your hard-earned money? Are you truly funding your own retirement and building a secure future for your family? Or are you just paying for a fund manager's expensive marketing illusions? The data is absolutely clear. The honest path is right there in front of you. And the choice? Well, that's entirely yours.